Welcome, 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 ladies and gentlemen and beautiful people. Today is April 23rd, and I'm going to be going over some simple strategies that you're going to use with confluence in order to look for better entries, right? Forex is about looking for the best entries that you can possibly get and then going in your direction for the allotted amount of pips that you have in your trading plan, okay? It's important to have a trading plan, guys. If you guys do not have a trading plan at the moment, be sure to have one and set one up. There's plenty of pip journals and pip sheets that you can have to know, okay, how many pips am I getting on my next trade? Very important to have. So today, guys, I'm going to be going over a couple of things. One is going to be Fibonacci retracements and how we use them on several time frames in order to look for optimal trade entries. And then we are also going to go over candlestick patterns. I'm thinking we should go over candlestick patterns first because it's something that's going to maybe take a little more time. And why is it going to take a little more time? It's because there's so many different types of candlestick patterns to look out for and to kind of identify for you to be able to take great entries in the market. And candlesticks are going to help you do that. And one of the most important candlesticks that I like to see and I like to use with support and resistance, which is just supply and demand, is the pin bar candlestick, right? The pin bar candlestick. Why do I like to use the pin bar candlestick? Because it allows me to see exhaustion in the market. It allows me to know when the market is more bound to reverse in a certain direction. Now, don't get it twisted. That just because it gives you a pin bar to one direction doesn't mean that ultimately is going to go in your direction for 50, 100, 150 pips. It just doesn't always go that way. But just understand that these are going to be part of your confluence to then take that trade in the direction you want to go in, okay? So very, very important. So pin bars, you're going to usually see them at support and resistance levels or trend lines, which we went over in the last video. And you're also going to see them when moving averages get crossed or finally go and spread open in your direction. If you do not trade with moving averages, or if you do trade with moving averages, this is also going to be some confluence in your trading direction. All right. So let's take a look at what these candlesticks look like. So a pin bar is going to look like a pin bar right here. A pin bar the wick must be longer than the body. Okay. The wick must be longer than the body. The wick must be longer than the previous bars, meaning that this previous bullish engulfing prior is going to then show the next candle being a long wick if you are going to get that pin bar. And it needs to close and open, right, under. It needs to close and open under, okay? The body is at one end of the wick, all right? Price closes within the previous price, meaning, again, it needs to close under. And it's going to happen at either a high or a low. Candlesticks are very important, guys. And the reason candlesticks are important is because, again, it's going to show a high probability reversal in the market. Let's go over some bullish candlestick patterns to look out for. Some of the ones that I love to look out for are the ones on the top, the single candle patterns, right? So more like hammer, right? Which we just saw, that's kind of like a pin bar, correct? And then inverted hammer, right? You'll see those. You'll see some dragonfly dojis, right? Right over here. You'll also see some bullish spinning tops. You'll see where the wick goes up and then the wick comes back down, but it closes almost at the same price that it opened. All right. And what you'll see on neutral price points are these dojis, right? These dojis are going to open and then close at the same place, right? Giving you this decision in the market. Then you also have two candlestick patterns that come together that give you some more confluence. Ones that I use are tweezer bottoms for bullish, and bullish engulfings right over here. It's going to be very important to identify those, because once you're able to identify those bullish patterns, it's also going to add confluence to when you want to get into a trade. So if you don't see these candlestick patterns, right, and you see these candlesticks not forming in a area where you think price is going to reverse, then you might think twice before hitting that buy on your MetaTrader 4, or maybe that buy if you're trading binary options. Okay, 3+ candlestick patterns are my favorite, because these are going to give you so much more confluence. And let's go over them. Right here at the bottom left, we have a morning star formation, right? And we have more rules to these candlestick patterns. If you guys want to get to my personal mentorship, the link is going to be below for a free web class. It's going to be you can register any day from Sunday through Thursday at 8 p.m. The link is going to be on the bottom, so be on the look for that. Right. So you also have a bullish abandoned baby, which is almost the same as a morning star, but you have a larger bullish candle, which engulfs the previous bearish candle to the left. All right, so be on the lookout. Then you also have 3 white soldiers, where you're going to get 3 consecutive, almost same size candlesticks to the upside, right? So that's going to be a great indication for a buy pattern as well. Then we have the 3-line strike, which is going to be 3 bearish candles, always smaller than one another. So the first one is going to be the largest. Then the second candle is going to be a little smaller than that. The third candle is going to be the smallest. And then you're going to see a big bullish engulfing candle getting out of that area. So definitely be on the lookout for those 3-line strikes as well. My favorite of all time, and usually when I see this morning doji star, right, this morning star kind of, right, what you want to see is that this bullish candle, right, once it gives you the doji, this bullish candle closes at least at 50% of this bearish candle that it gave you previously. That's going to be something you're going to see at either support, at a support level, okay? It's going to be at a support level. Then you have the 3 outside up. I really don't use that one. And then the 3 inside up, which I don't use as well. These are going to be some candlestick patterns. If you want to look for more effective candlesticks patterns that you can read into, you can look at the Candlestick Bible. So guys can write that down, look that up. You can look it up in an ebook, or actually buy the actual book, or the printed digital copy for your computer or phone. The Candlestick Bible is going to go over all the candlesticks, all the Japanese candlesticks, all of the candlesticks that you can imagine that are going to help you sharpen up these skills when looking at the market. Okay, so real quick, before we go into bearish candlesticks, here are the candlestick basics. Okay, so you have the open and the close of the candle, and then you have the high and the low. So the high and the low are where the wicks are going to, just like any candle, right? If you have a candle at home, right? You have the actual candle and then the wick to light it. It's the same exact thing, guys. You're going to see the high, which is going to be the high and the open, which is going to create a wick, and then the close and the low, which are also going to create a wick. So that's going to be where the market was at a high and a low, and then it's also going to tell you where the open and close of that candle is. All right, so it's important to know where the open and close of the candles are, even though the highs and the lows are very important to identify where fair value gaps will close in the future. But we'll go over that in a more detail later on. So real quick, Usually the bearish candlestick patterns are going to be the same thing, all right? They're just going to be inverted and in the other direction. It's like looking at a mirror, right? If you see a hammer stick, a hammer candle, right? You're going to see the same candles, but in the opposite direction. So a hanging man is going to be the same thing as kind of like as an inverted hammer, but just the other way around, right? A shooting star, same thing, kind of like a dragonfly doji pattern, but the other way around, right? Gravestone doji, same thing, and a bearish spinning top is going to be the same thing as a bullish spinning top. And you're going to see the same evening star formation all the way at the bottom right. That's going to give you possibly the best candlestick formation I've seen thus far. Every time I see that pattern, it just like boom, light bulb. I'm now looking at the market. If it happens around London kill zone, which is about 2 a.m. to 4 a.m., I'm looking to see what the market wants to do once it gives me these candlesticks. And then if it's giving me these patterns around New York time, which is 7 a.m. to 10 a.m. New York Eastern time, if you're here on the East Coast, you're going to have the best probability of catching the best trades when you see these candlestick patterns appear around kill zone. Okay. So if you guys want to get more into, right, if you guys want to get more into candlestick patterns takes a while to really kind of get the gist of it, because you have to see it over and over and over again. But if you guys are taking notes, take notes. This is going to be on YouTube, so you guys can go back, take notes, write down the candlestick patterns that you guys want to study, right? Take them down and really study these candlestick patterns. You will see them happen at support and resistance. And let me go ahead and give you guys a nice little example of some morning stars, right? Morning star formations here before reversals, right? So let me give you one good example of a nice little morning star. This one right here, this formation right here, this 3 candlestick formation. And the way we know that this was valid is that I take my Fibonacci, and this is one way that I use my Fibonacci, but I use my Fibonacci and I measure out this candlestick, and it has to give me 50% or more in order for it to be valid. What this did do was it was retest this low again before dipping away, but this did give you a candlestick pattern that you want to pay attention to here around kill zone. So kill zone was right here, right? Gave you the entry for kill zone after giving you a morning star and then took it away, right? Another candlestick pattern was a bullish engulfing. I mean, a bearish engulfing candle, right? Away from the zone, and then dipped away, giving you a nice amount of pips to the downside, right? So we see them all the time, guys. We see these all the time. These bullish engulfing candles, they happen all the time at reversals, right? At reversals, these bullish engulfing candles. So be on the lookout for that. Be on the lookout for railroad patterns as well, and be on the lookout for these morning stars and evening star formations that are going to give you a nice little analysis as to where to take the market next. All right, guys. So that's enough about candlesticks. What I want to go over today is your Fibonacci levels. Okay, Fibonacci levels are going to help you understand where the market wants to go next, right? And these are going to give you, right, the optimal trade entry that you're looking for. My fibs are really simple. Usually what I want to do in order to draw out fibs is that I'm first looking for where my swing highs are and where my swing lows are. So what identifies a swing low or a swing high? What identifies that? So Usually you have your support and resistance levels already drawn up. So this is going to give you a good idea as to where these levels are at, right? So usually before I'm kind of doing my analysis on where my swing high or my swing low is, what I do, guys, is I take my ruler and on the daily, I go back about 24 days, right? About 24 days. That 24 days is going to give me a good idea of where the last swings were. Okay. So when I identify where the swing was, right? We got a swing high. That was the swing. And then we have a swing low. So usually what I do is if you're looking for a move to the upside, what you want to do is that you want to keep this just like this, right? You want price to go into the premium levels, right? Price will go into premium levels. And what a premium is really think about it, right? If you were in a store, right? You got price goes into either a premium, right? Or price goes into a discount. Where do you think you want to buy something at? If you are in a store, you want to buy things at a discount, right? So if things are at a discount, right, and you have this downtrend, right, because it structurally, it did give you this lower low, okay, from this last low, all right? So if this was the last low, you now know that this is a downtrend, okay? So because this is a downtrend, where do you think price is going to go to before going in the direction it's looking to go in, right? You're looking to have price come up into discount range before dropping back down. Why? Because now price gave you this big move, right? Price then gave you above 50%, right? Gave you this move, right? Gave you at least back 50% of this move, right? As you see, from this high to this low, right? Gave you back 50%, which is called equilibrium. Right? Equilibrium here at the 50. But remember, the new swing is from here to there. So equilibrium is at the 50. So from this swing high to the swing low, you have yet to come in to equilibrium. Usually price always wants to come hit equilibrium. That's where price in the market is either at a discount. It's neither at a discount or neither at a premium. All right. So when the market comes back down, what you want to see before it coming back up is price to come down into these discounted levels. If we want to see a price back up, because why? If a bank can get a buy, would they buy here or would they buy down here? They would buy down here because this is a better price. It is a better price to get your entry for the uptrend, right? I have this pretty good strategy, right? When using the fibs, I look for certain levels, and this level is anywhere within optimal trading entry. And I'm gonna explain how I look for those entries. Okay, let's look for a nice zone here where we can mark up, right? And let's look for a nice swing high to swing low. So let's go ahead and do it from here to there. All right, so this swing high that we identified, right? Right, that's the swing high. And then we have the swing low, which gives us a swing low is a bunch of red candles followed by 2 green candles, right? And it gave us the swing high. So we already, once we've identified the swing high and the swing low, we have already drew out the fibs. And you're constantly drawing out fibs because you want to know where price is going to hit before going into the direction you're looking to go, right? So this is already giving us a downtrend, right? But mind you, this didn't happen yet. These 3 candles didn't happen yet, right? So you're already drawing out a trend line just like so right here, right? You already would have drawn that out. So what you're looking for, guys, is a optimal trade entry. Where's your optimal trade entry? Your optimal trade entry is going to be anywhere in this zone above the 50. Why? Because now price is at a discount. Price is at a discount when in this zone. All right, you already identified this is a downtrend. So what you're waiting for once market gives you swing highs and swings lows is for price to react and come back up into discount zones to where then you want to resell until the market gives you a high probability reversal. This is a pin bar. You see how long of a bar of a pin this is, right? Showing you that this market not only came down, right? Came down, giving you this turtle soup W, right? W's and M's, giving you this turtle soup W, but pin bar here at this support, and then came back up. But again, what did it do? Came back into discount and then sold off again. All right. But now this identified this as a swing back up to the upside, meaning that you are now redrawing fibs. Remember, your optimal trade entry, where I like to take my trades, are the 79% retracement. These are going to be wick entries as such. These are going to be wick entries as such almost every single time. The 21 is just an inverse of the 79. And what this 79 means within the Fibonacci ratios, all that means is that it's a continuation. So anytime you see a downtrend into a Fibonacci swing high to swing low, you usually are going to get a retracement continuation down, right? Continuation down or up, depending on what you're looking at the market. But in this example, is a downtrend, right? Back down. Now let's redraw it, right? Let's re-identify where the swing highs and swing lows are. Boom. Right. So again, if you're doing this as the market moves, then you're able to kind of see where the market wants to go. Now it gave us a new swing high, and now we identified the new swing low. Came back down, gave us this again, right? This pin bar, morning star, right? Morning stars you only see as support. So now in my brain, I'm saying I'm no longer looking for sell opportunities. This big wick told me otherwise. Now I'm drawing my wicks in the other direction. I'm drawing my fibs in the other direction, right? And I usually do it from wick to wick. You could have even drew it out from all the way down to the wick. Most people do it to the bodies. So you can do it to the bodies, body to body, whichever one you feel more comfortable with. But again, guys, if you have this zone and price, now you know price is going to the upside, where do you want price to come back into to buy? Into this area. What did price do? Price left the area, came back into with this wick, hit off the 70.5, which is discount, and then come up. Came back into discount, and then came right back up. And you guys can identify these moves all the time. So now, not only did we identify a head and shoulders pattern right over here, right over here, right, giving us that confluence that we want to buy this right shoulder, right? We want to buy this right shoulder, but it also gave us a full swing high to low right into your discount area, which is right here. And then you have your entry. That's your entry, okay? That right there would be your entry. And mind you guys, these are days. This is the daily candles. So if you caught this entry on the daily candle on when this market gave you this bullish engulfing right here, it did engulf, you could have caught the next candle. Even if you caught the next 2 days of buy, it would have been 169.3 pips, right? At a nano, that's $16. At a micro, that's $169. And at a standard, it is $1,693. Guys, if you guys want more of this mentorship, click the link below. 8 p.m. Sunday through Thursday, we have access to our private mentorship, which you can have access to by just joining, clicking the link below, checking out the information that we have for you guys. And if it's a great fit, you guys can join our private mentorship, and we can give you some great setups, some great ways to use fibs, some great ways to identify more candlestick patterns, and ways that you can put your confluence together in order to master your trading technique. Guys, that'll be all for today. Thank you for your time, and I'll see you guys on the other side.